And the markets are idling. But of course they are, because in a mere less than 24 hours ahead, we have what is probably the biggest macro event risk for the week. And who in the world wants to get in front of that train? Welcome. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And of course, we are going to focus today on the elephant in the room for this week, the FOMC monetary policy announcement. And that is almost certainly not only the focus for this week, but perhaps even for the next month, 2, 3 at minimal. Because what the Fed is going to do here will be one of those big quarterly adjustments of policy where we not only get tinkering at the margins of the language in the policy statement, a bit here, a bit there on the outlook for rates. No, we are going to get the quarterly forecast update. And the last time we got that was in December, and arguably, definitionally so. So what we're going to do here is take a look at what all the moving parts are, take a look at how they might evolve as this update is released, and what it might mean for stocks, and what it might mean for other markets as well. So let's begin here with first and foremost the key question to kind of frame our discussion here around what this means for stocks. Is this the straw that breaks the camel's back? Why do we ask this? Well, if we take a look at how this has evolved in, let's call it the past 5 months of a blistering stocks rally, shown here by the S&P 500 as a kind of catch-all for equity risk appetite. What we find is that quintessential to this move has been a favorable repricing of Fed policy expectations, followed by a hopeful hanging on, really up to just about a few weeks ago. So we arrive in late October, early November of last year, and the Fed says, right, it looks like we're done with rate hikes. September was a bit of a spook. Then November, the Fed comes out and says, okay, we feel that we're done. And we'll let you know when we're cutting. It'll be data dependent, but we are officially done hiking. We think we've arrived at the spot where we've done enough that inflation is going to get to our 2% objective within the time frame that we want it to. And so what you see as stocks find a bottom here and start to rise, you see the rollover in Fed policy expectations for 2024. So you see that the amount of rate cuts moves from about 3, we're sort of hovering around 75 basis points here, and moves out to about 6, 150 basis points. Then the new year starts, and this begins to shift in the opposite direction. And the key here is, as the Fed comes out in late December and gives us the last version of the kind of update that we're about to get here in less than 24 hours, it establishes a baseline and says, this is what we think for rate cuts next year. We think 80 basis points. Here are the makings of that adjustment. So here is the updated set as of December. Take a look at what's going on here. So for GDP, most critically, the outlook for 2024, because of course this is December. By this point, 2023 is essentially a foregone conclusion. Now, what we're looking at is essentially what's going to happen for the following year. So if we look here, the outlook on growth, lower. That's probably a little bit dark. Let's see if we can make it a little bit less obtrusive here. So the move from 1.5 to 1.4, lower. The adjustment on inflation from 2.5 to 2.4, lower. The adjustment on core inflation from 2.6 to 2.4, lower. And with that, what do we get? The September projection was from 5.6 to 5.1% on rates. That's a 50 basis point cut. The update from 5.4, so rates will top out lower, and they will go lower. So here, down 80. So not only do we get a lower peak in rates, we also get them down by an extra rate cut. So from 50 basis points to 80, 80 is essentially 75 rounded with a 5 basis point margin of error. So lower peak in rates and more cuts. So with that, the markets say, right, lower growth, lower inflation, more cuts. Makes sense. What have we seen actually since the beginning of the year? Well, the story has been, let us call it, otherwise. What we actually see is that U.S. economic performance, at least as far as looking at how the data has performed relative to forecasts, it's actually been better by a widening margin. Now, the way that this economic surprise index from Citigroup works is when you're above zero, here's the zero line right here, the data is tending to outperform in general. So all of this, of course, is above zero. And so generally speaking, U.S. economic data is tending to be better than baseline forecasts. That might help to explain a sort of tendency in risk appetite to be well supported more generally. But there's clearly flavors here. So in the second half of last year, the data is deteriorating relative to expectations, at least as far as its ability to beat by a shrinking versus wider margin. But then as we start the new year, the data starts to outperform. Much of this was an upside revision in forecasts. In fact, you can see the Fed's own forecasts for growth in 2023 had to go up from 2.1 to 2.6%. That's a belated adjustment reflecting what is already occurring in the market's expectations. So you see the bar on growth raised here, so it becomes more difficult for the data to beat until by the end of the year, you essentially arrive at where expectations and realized results come together in harmony, if only for a brief moment. And then the data starts to beat on the upside. It's become a little bit more soggy, let's call it, since about mid-February, late February onward, but the overall thrust here nevertheless is of a stronger economy and of hotter inflation than expected. In fact, we pointedly saw that over the course of the past several weeks, we had higher CPI than expected, higher PPI than expected, stronger jobs data than expected in a lot of ways. Even as the unemployment rate went up, job creation was higher. And of course, we also saw a bunch of the inputs into job creation. For example, job openings higher, GDP numbers better than expected, PMI activity surveys a bit better than expected. So the thrust here is that the economy has not so much slowed as picked up so far, at least in the first quarter of the year, whereas the trajectory of the Fed's adjustment was for a cooling. And so if we then look at these expectations here, the question becomes, well, if this was the adjustment, lower on growth, lower on inflation, that got us more rate cuts rather here, it seems very difficult to imagine that we don't now have to adjust in the opposite direction. The economy has been hotter. These forecasts might well need to be revised. It seems difficult to imagine that they won't be. That then might necessitate a shrinking in the number of cuts that the markets are betting on. But of course, the markets have already made that move. And at this point, we are looking for 63 basis points in rate cuts, which essentially gives us the first two rate cuts all the way baked in. So 50 basis points are there. And beyond that, 13 out of the next 25 basis points are already priced in. So 13 out of 25 of the third cut are baked in. That's almost exactly 50-50. We're at basically a 52% chance for that third cut. Now, very pointedly here was the Fed's baseline in the green line. Once we get far enough away from that, we can clearly see stocks start to struggle. Because at this point, the market is essentially saying, well, now the pricing is on the hawkish side of the baseline, at least until the baseline is moved. And so if the Fed then has to update forecasts, it ostensibly has to move that baseline and may well need to shift it closer to something like a preference for 2 cuts rather than 3, perhaps not quite all the way back to 50, but maybe something more like 60-ish to be closer in line with where the markets are. If we look at the timeline as it presents itself here, what we find is, again, nothing is being baked in for March, nothing for May, nothing for June. The first time that we really get the full first rate cut all the way baked in is September. So there's a slight chance that we get something in July, and then we're fully baked in by September. So somewhere in here is the first cut. Now, there has been a lot of conversation about proximity to the election and the idea that the Fed might not want to do this so close to the election as to make a move in September so as not to get sucked into the political news cycle. So maybe then that either biases us toward July, assuming that holds any water. Of course, we don't know. Or you might see the 2 cuts now on the menu, assuming that is cemented, appear here in November and December. We can see that by November, we cautiously have a second cut in the forecast, and then here's that slight chance for a little bit more in December. If the message from the Fed is sufficiently in line with what we're seeing already, then perhaps we land somewhere at 2 cuts, and then the conversation becomes of timeline and of the sort of space where that occurs. Does it occur after the election? Can it occur before the election? And there, we're going to try to read the tea leaves in what Jay Powell is going to say at the press conference following the release of these forecasts and the announcements. Now, where markets can find their source of risk sentiment, where markets can sort of hope to find a reprieve, is if these forecasts are revised higher. So higher growth, higher inflation, just to retroactively backfill what's already occurred so far in the first quarter, and we get fewer cuts here, it's possible that what we see is just a shift in time, that basically fewer cuts here starts looking like more cuts in 2025, because the Fed still ostensibly is talking about landing at the 2% inflation target by 2026, such is their goal. 2% inflation in the medium term, loosely defined as about 2 to 3 years. So ostensibly, this doesn't move if the Fed is to continue to say that they remain on a path to getting where they need to go, as opposed to restarting rate hikes, which is ostensibly not on the menu. So if that's the case, then perhaps something more hawkish here gets paid for with something less hawkish here. So perhaps growth for 2025 is diluted, and inflation for 2025 is diluted a bit to some extent, at least at the core. And then you arrive at this endpoint still, and there's more easing then that gets pushed out into next year. Now, the markets might then find a reason to say, okay, fine, this is okay. It's not that we're going to have fewer cuts, it's that the timeline has just shifted a bit. However, if we look at the priced-in expectations relative to inflation, what we see is that what the stronger growth has done is lifted market-based measures of inflation. And so far, we're still in line with the Fed's longer-term average. Here, we can see that the Fed expects that longer-term rates will settle at 2.5% as inflation settles at 2%. We can see here that if you look at inflation expectations now, although they are still expected to settle shy of the Fed's longer term rate, we are nevertheless looking at inflation expectations that have been going higher. So the market is loudly saying that this is an adjustment that's had to occur. But what's really eye-catching here is that rate projections for both this year and end of 2025 have increased. So the markets are now decidedly on the hawkish side of the Fed when we look at where we are going to land here. And that is something very important to keep in mind, because for right now, the markets would find room in this, perhaps, to get their optimism. If this is now baked in about right for 2024, but this sympathetic rise is maybe a bit overdone because the Fed is going to borrow from here to make this make sense, well, that could be one source of support for markets where they would essentially reason, okay, we've priced in everything that there was to do. There isn't any more of a hawkish adjustment that needs to happen. But if that's the case, then we might well be looking at a situation where yields find a top, bonds attempt to recover. But it's not so obvious that stocks would feel the joy, because if the story from here to here has been first more cuts and then acceptable cuts to feel comfortable, if the green line basically moves here, right in line with where the markets are, the story will be out of narrative. There will be nothing else to say. Speculation will have become reality without anything else occurring. And if nothing else, that might encourage divestment, at least to some extent. This doesn't say anything about long-term earnings prospects, long-term economic prospects. No, just tactically, there may be money here that's waiting for the green light to take some profits on what has been a tremendous rally. Almost a one-way rally. And so that alone may be enough to say the story is over, take something off the table, and stocks correct lower. The story gets more interesting when we look at the US dollar, which has perked up a bit as we've edged into a less dovish policy setting. You can see as rate cuts have diminished, so too the dollar has rebounded, albeit with some correction as this has corrected as well. If the Fed basically meets us at expectations, one would reason that we've also arrived at the spot where the dollar's yield advantage has been locked in against the other major central banks. We saw this in spades with the RBA just overnight, where they signaled a thought process that is getting them closer to cutting. And so the dollar rallied. So the dollar may actually fare better even as the Fed anchors, just because its yield advantage will have been locked in for at least a quarter or two. And the really big story then is the Japanese yen. You can see it moved very much inversely of Fed policy odds. So as cuts build, the yen rises. As cuts come off, the yen sells off. And no doubt part of the story, of course, was founded in Japan itself. Well, we've just had them move out of the way overnight. The Bank of Japan raised rates as broadly expected out of negative territory and scrapped yield curve control. So this is back to being a Fed-driven story. If that locks in the idea that the only central bank cutting, or not cutting rather, is the BOJ, and the other speculation that was here to be had both over the Fed and the BOJ has been chased out of the market, then perhaps we finally reached a low here and the recovery can begin. And that is macro money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what happens or is likely to happen thereafter. Back on with Chris for Futures Power Hour on Fridays, on with Tom and Victor for First Call on Sundays, writing for the news and insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. I will see you after the dust settles on this FOMC announcement when macro money returns tomorrow. In the meantime, happy trading.